The ways of reduction are: disposition or sale, known as the inherent risks, can be reduced through sale of a part of the business. New business reduction refers to a reduction in the amount of new business should reduce the risk being assumed. Next is transfer. Transfer can be divided into three, which are sharing experience, hedging, and special purpose entity, SPE. Sharing experience with customer. There is direct sharing of investment performance with the customer. Some of these products may also provide the customer with various option and floor guarantees. For life insurance products, the customer shares an emerging experience through a scale of policyholder dividends or bonuses, which is adjusted on an annual basis. Hedging. Hedging used by financial service providers to offset a variety of market risk exposures. The degree to which the inherent risk is mitigated depends on the specifics of the hedging program. For example, the hedging long-term equity exposure using short-term puts still leaves the business exposed to a variety of risk, including basis and increased operational risk required. Special Purpose Entity, SPE. SPE, also known as Special Purpose Vehicle, SPV, has limited liability, so its losses do not directly affect the originating institution. SPE are usually sufficiently spare that they are also not affected by the originator's performance. Risk manager need to carefully consider the risks actually transferred, permanence of transfers, and under what condition the risk might revert back. SPE can be a risk management tool for an originating institution or for others who wish to invest in a specific aspect of the institution business without being exposed to whole institution. Then, another risk management strategy is exploit. A risk may represent an opportunity. Exploit refers to change the original plans with better outcomes. This could be clear opportunity for the outcome to be more favorable than anticipated, or it could simply be an opportunity to exploit a relative advantage. For example, the cost of accepting a particular risk may be lower than it would be for some or all of the competition. Where an opportunity exists and the insurer has the capacity to exploit it, then it probably makes sense to do so. One example might be the active pursuit of riskier, capital-intensive business on the basis of access to cheaper capital. Last but not least, reinsurance. Reinsurance refers to insurance purchased by an insurer to provide protection against some or all of certain risk of the insurance policies issued by the insurer. In exchange for the assumption of these risks, the insurer receives payment in the form of reinsurance premiums or allowances from the direct writer of the business, the insurer. From the perspective of insurer, reinsurance provides for a transfer of risk to reinsurer. The extent of transfer depends on the specifics of the reinsurance agreement or treaty. Reinsurance products are difficult to price owing to the limited data available on which to base the pricing. Reinsurers must monitor the profile of their insurance risks very carefully, the reason that they were quoted in the first place. They will often retrocede a high proportion of the risk and in turn, accept retrocessions from other reinsurers. The reasons to purchase reinsurance are: some insurers, especially small ones, need stop-loss reinsurance to limit the aggregate cost of claims in a given year. Insurers may be able to use the financial reporting impact of reinsurance agreements to achieve earning and surplus objectives and to minimize tax. One benefit provided by reinsurance is their experience in underwriting. This can prove valuable during the design, pricing, and underwriting of products, especially new, novel, large or complex ones. Thank you.